Hey everyone, in this video I'm going to value Google, also known as Alphabet Inc., and see whether it's a good time to buy their stock or not. If you're new to the channel, my name is Dan. I do a lot of stock analysis on this channel. So if you're into that kind of thing, if you're into investing and stock analysis, please consider hitting that subscribe button so you can check out more videos like this one. Okay, with that out of the way, let's get into it. So here's how Google makes money. This is their breakdown by segment here. You've got 61% of their revenues from Google search, 9% from YouTube ads. So 70% right there is just from advertising on Google and YouTube. Then you've got 13% coming from Google Network members' properties. Things you might know that are included in there are things like Gmail and Google Maps. And you've got cloud accounting for 6% of their revenue. That's a growing area. And 11% comes from other things. So Google has their hands in a lot of things right now, and they're hoping they're going to grow over time. Here's a breakdown by geographic area. The United States accounts for close to half of Google's revenue. The next closest one is Europe, Middle East, and Africa region. Then you've got Asia Pacific and other Americas. So they're actually pretty well diversified in terms of currency fluctuations and things like that. Here's a quick snapshot of their balance sheet. You can see they're very underlevered with a liabilities to assets ratio of about 28%. That's very safe. There's no concerns there for solvency. As well, their interest coverage ratio is over 350, so they can easily cover their very tiny interest expense with the money they bring in. They have positive working capital, as you can see. The number is in millions, so that's actually $116 billion of working capital. And their current ratio and quick ratio, which amount to about the same thing because of their very tiny level of inventory, those ratios are very healthy as well. Current ratio of 3.4 means that their current assets are 3.4 times what their current liabilities are, so they really have no liquidity concerns either. Although their balance sheet is quite safe, Google does have two big antitrust lawsuits hanging over them for the moment. One is coming from the Department of Justice. Another is coming from a coalition of states. Both of them are targeting Google because they have such dominance in the search industry. Now, how big of a risk is this? It's very hard to quantify. We're going to have to try and consider it when we value the company, but it is hard to quantify. It may be that nothing comes of it. I do notice that the U.S. Congress likes to drag the CEOs of Twitter, Facebook, and Google down for questioning, but not much seems to happen about it so far. So we'll have to see if that continues to be the case. So here's a quick look at Google. You can see they're up 28% for the year. Very impressive, but it does actually lag behind some of their competitors, other FANG stocks, such as Apple. They have a market cap of $1.18 trillion, and their price earnings ratio right now is close to 34. Now, it's usually not a good idea to pay 34 times the company's earnings. That's a horrible deal, except, as you know, Alphabet is growing, and that growth is expected to continue. So here's a DuPont analysis for Alphabet. I got about 5 years worth of data. I always hate to look at just 1 year. It might not be representative. You do have unusual years sometimes, but they're pretty consistent. You can see their return on equity is usually about 17 or 18%. Now, how do they achieve that? Well, I like their net income margin. It's usually about 20% or so, meaning for every dollar of sales, they keep 20 cents in profit. That's pretty good. Their asset turnover is not so impressive. I would expect it to be a lot better for a tech company. You know, they don't need so many assets in place to generate their revenue, I would think. I mean, look, in the most recent year, you got 0.62. So for every dollar of assets they own, they generated 62 cents in sales. That's not so great. And again, they're very under leveraged, so their equity multiplier is not very big. I would like to see that go up. Okay, so here's the balance sheet for Google. And what I really don't like to see here is that they have such a huge pile of cash and short-term investments. So these are in terms of millions of dollars. So realize right now, guys, that Google is holding about $132 billion basically in cash. It's either cash or short-term things like treasury bills just to get a little interest revenue there. What I've done on this column over here is to take every number on the balance sheet and divide it by total assets. So realize here that for Google, 44% of their assets are just cash. It's a very inefficient way to run a company, and I really like to see them reinvest it in something that earns more, or just pay it out to shareholders in the form of a dividend or share buybacks. Don't just sit on it. They're really dragging down the return on equity here. Okay, so even though Google is trading at about 34 times its earnings, investors are very interested in this stock because of their incredible streak of growth. So 34 times earnings is not a good deal, but look at this. Their earnings are probably going to go up quite a bit more based on their record here. In 2011, they generated about $37 billion in total revenues, and this past year they generated about $171 billion. That's close to a 5 times increase just in the past decade. So here I'm looking at Google's operating margin and net income margin over time. Look at them, 10 years ago, back in 2011. They reported operating margins of about 32%. Now that's just shrunk over time gradually to the point that in the trailing 12-month period, we're down to 20.3%. Okay, so I think the last graph really illustrates the problem with hoarding cash on your balance sheet. As an investor, do I want to buy a company that just has a pile of cash that sits there? I don't want to do that. I want whatever I invest in to be working as hard as it can to deploy that capital to its best use. And if they don't have a good use for that capital, I wish they would just buy the shares back or issue dividends. So far, they're not doing that, and so you have a good chunk of Google's assets that are working hard for you, producing nice revenues, and then you've got this big and growing pile of cash on the balance sheet that just sits there in treasury bills. And I really don't like that part. So we are going to have to factor that, declining return on equity into our forecasts. Okay, so at this point in the video, I'm going to use an intrinsic valuation model to value the stock of Alphabet Inc. What I'm going to do here is I'm going to make a few assumptions. If you ever run one of these models, you have to assume a few things. Now, it's going to be a free cash flow to equity model. If you haven't seen my video on that, check it out in the description below. But the idea is pretty simple. The value of any asset is equal to the stream of cash flows that asset's going to produce over time. We have to make a few assumptions, though. One of them is this. How long can Google keep up its growth? And I'm going to say about 5 years. Analysts are currently forecasting they're going to be able to keep it up for the next 5 years. But with a market cap of over $1 trillion, I can't really assume they're going to be able to keep it up longer than that. I'm going to have to say that after that period, they're just going to kind of flatline in their profits. Maybe, increasing just a little bit every year after that. We'll say 2%. The other assumption I have to make is how much will Google grow during that, abnormal period during the next 5 years. I'm going to say anywhere from 10 to 20% per year, and we're going to show how the value differs depending on that. And lastly, we need a discount rate that reflects the risks of investing in Google. So let's plug the numbers in and see what we get. Okay, so what I have here is a valuation matrix. Every cell is basically the fair value of a share of Google, depending on the discount rate here on the vertical or the growth in free cash flows here on the horizontal. So like this cell right here, this means the stock would be worth about $2,459 if it grows at 14% for the next 5 years. Their free cash flows grow at that rate, and assuming a 7% discount rate. Another way of looking at this whole thing is to say, okay, for example, if I think they're going to grow their free cash flows at 11%, and I want to get a 9% return on my investment, I can't pay more than $1,492 for a share of Google. So which cell is most likely? Okay, so based on what analysts are forecasting, this column here is actually the most likely. And then it just depends on the discount rate you want to use. I personally am going to use about 7. I think anywhere from 6 to 9 is reasonable. I am not overly concerned about some of those lawsuits coming up, and I think Google has a very, very wide moat for their business. So I think this is the most likely sell, but I definitely want to show you how the value would change depending on different growth rates or discount rates. If you look at the matrix below, you can then see how much of a deal or how much of a bad deal it is. If it's a good deal, it's in green basically relative to the share price today. And you can see here in the sell that I think is most likely, Google's still undervalued by about 40%, which is a pretty darn good deal. If you're a bit more pessimistic, maybe you want to use a higher discount rate, you can still see that Google is still undervalued unless they have the worst, growth rate I plugged in, about 8% that'd be a little pessimistic there. So overall, it does look like a nice deal. The last piece of information I do like to consider is insider trading data. And so we see in the past 3 months, you got some buys, you got some insider sales, about twice as many sales as buys. That's not so good, but the total number is not that great. If you look at the number of shares involved, you got 38,000 shares sold and only about 19,000 shares bought. So about a 2-to-1 ratio. Overall, a slightly negative outlook, I would say. Remember, the insiders are going to know more than we do about what's about to happen in the future. Okay, so here are my final thoughts on Google stock. I think they have a very healthy balance sheet. It's actually a little bit too healthy. The company, their return on equity isn't as good as it could be. That being said, when you run the numbers and you look at the growth rates we're expecting, it's actually a good deal under more scenarios than not. So just based on that alone, I would say it's a buy. But if top management, which has managed the company brilliantly, but if any area where I would say they could improve is in deploying that cash. If they could just take that cash and buy some shares back or just issue dividends, the company is going to become worth a lot more. And the return on equity is going to go up a lot as well. So, I think there's a bright spot in the future for Google, and I'm going to invest in it today. That's just my opinion. I hope you liked the video. If you did, give it that thumbs up. Thank you for watching.